Before we dive in, please remember that I am not a licensed financial advisor or insurance professional. This video is for educational and informational purposes only. The information provided is based on research and experience, but it is not a substitute for professional financial advice. You should always consult with a qualified professional before making any decisions about your own insurance or financial situation. Imagine this for a second. You did it. You finally bought that car you've been dreaming about. You worked hard, you saved up, you negotiated a decent deal, and now it's sitting in your driveway. That new car smell is intoxicating. You take it for a spin, the engine is smooth, the tech is amazing, life is good. For 6 months it's perfect. Then one Tuesday afternoon, a driver texting on their phone blows through a stop sign and T-bones you. The airbags deploy, the car is a mangled wreck. The most important thing is, you're okay. Shaken but okay. A week later you get the call. It's your auto insurance company. They've assessed the damage, and the car is officially a total loss. They tell you they've calculated the car's actual cash value at $28,000, and they'll be cutting you a check. You hang up relieved for a moment. Then a sinking feeling hits you. You pull up your auto loan statement. After 6 months of payments, you still owe the bank $35,000. Wait, the insurance company is giving you $28,000. You owe $35,000. That's a $7,000 difference. A $7,000 hole. Suddenly, you realize the terrifying truth. You have no car, but you are now legally on the hook to write a check for $7,000 to a bank for a vehicle that is sitting in a scrapyard. This isn't a rare nightmare scenario. This exact situation financially cripples thousands of Americans every single year. It's called being upside down or underwater on your loan, and the chasm between what your insurance pays and what you owe is known as the gap. And that is precisely why we're here today. We are going to talk about the one thing designed to prevent this financial catastrophe: gap insurance. Guaranteed asset protection. By the end of this video, you will understand exactly what it is, how it actually works, and most importantly, you will have a crystal clear, no-nonsense framework to determine if you really need it for your car. We're going to demystify the jargon, cut through the high-pressure sales tactics you might face at a dealership, and empower you with the knowledge to make a smart, confident decision that could literally save you from financial disaster. So how does this gap, this financial trap, even exist? It all comes down to one simple, brutal word: depreciation. The moment you sign the paperwork and drive your shiny new car off the dealership lot, it starts losing value. It's like an invisible countdown timer on its worth begins ticking down fast. The common statistic you hear is that a new car can lose up to 20% of its value in the very first year, with a significant chunk of that happening in the first few minutes of ownership. Think about that. A $50,000 SUV could be worth just $40,000 by the time you get it home and parked. This depreciation doesn't stop. It's a constant downward force. Think of your car's value like a melting ice cube on a hot summer sidewalk. Every mile you drive, every new model year that gets announced, every little scratch or ding, it's all melting that value away. Meanwhile, your car loan balance is like a block of ice in a freezer. It goes down, but it goes down much more slowly, especially in the beginning of the loan. Let's visualize this, because this is the absolute key to understanding everything. Imagine 2 lines on a graph. The first line is your loan balance. It starts high at the full price you financed, and it slopes down gently and predictably as you make your monthly payments. For the first couple of years of a typical 5 or 6 year loan, a huge portion of your payment is just going towards interest, not the principal. So that line goes down very slowly at first. Now imagine the second line. This is your car's value. It starts at the same high point, but instead of a gentle slope, it's a cliff. It plummets downward in the first year, then continues to slope down faster than your loan balance line for the next several years. The space that opens up between those 2 lines, that wide open chasm where the amount you owe is higher than the car's actual worth, that is the gap. That is the danger zone. If your car is totaled while you're in that zone, you are financially exposed. This brings us to the single most misunderstood concept in auto insurance: actual cash value, or ACV. When your car is totaled, your insurance company does not care what you paid for it. They don't care what the sticker price was, and they certainly don't care how much you still owe the bank. Their legal obligation is to pay you the actual cash value of the vehicle, the microsecond before the accident occurred. So what is actual cash value? Simply put, it's the market price. It's what a willing buyer would have reasonably paid for your exact car, with its specific year, make, model, trim, mileage, and condition in your local market, right before it was destroyed. They look at sales data for similar cars in your area, they consult valuation guides, they factor in wear and tear, and they come up with a number. That number is the ACV. And because of that brutal reality of depreciation, in the first few years of ownership, that ACV is almost always thousands of dollars less than what you still owe on your loan. So let's put it all together. Depreciation relentlessly drives down your car's value. Your insurance company will only ever pay you that depreciated value, the ACV, in a total loss. Your loan balance, meanwhile, decreases at a snail's pace. The gap, therefore, is the direct mathematical difference between the check your insurance company writes you and the larger check you still have to write to your lender. It is the money you are responsible for, out of your own pocket, for a car that no longer exists. It's a debt with no asset to show for it. This is the problem that gap insurance was specifically created to solve. It is a unique, optional coverage that is designed to do one thing and one thing only: pay off that gap. It stands in that financial chasm for you. So in our earlier story, that $7,000 difference between the insurance payout and the loan balance? If you had gap insurance, it would have paid that $7,000 directly to the lender, clearing your debt. You would walk away with no car, yes, but more importantly, with no debt. You would be free to start fresh, without a massive financial anchor from your old car dragging you down. So how does this insurance actually work in practice? And the million-dollar question: where should you buy it? From the dealership's finance manager, who slides it into your paperwork at a premium price? Or are there other cheaper options they don't want you to know about? The difference in cost can be staggering, and knowing the right place to look is half the battle. Let's pull back the curtain on the finance office. You've just spent hours negotiating the price of your new car. You're tired, you're excited, and you're ready to sign the papers and drive home. This is the moment the dealership has been waiting for. The finance manager, often the most skilled salesperson in the entire building, sits you down in a quiet, sterile office. They slide a mountain of paperwork in front of you, speaking in a calm, reassuring tone. They start pointing to different boxes you need to sign, and then they pause. Now, they'll say, let's talk about protecting your investment. We have an incredible gap insurance program. If your car is totaled, this will cover the difference between what your insurance pays and what you still owe. Without it, you could be on the hook for thousands of dollars paying for a car you can't even drive. For just a few extra dollars a month, you can have total peace of mind. Sounds logical. Sounds responsible. And the price they quote, maybe $30 or $40 extra dollars a month, doesn't sound too bad. So you agree. You sign the form. What you might not realize is that you've just agreed to purchase a product for somewhere between $700 and $1,000. That few extra dollars a month is the total cost, plus interest, rolled into your car loan for the next 5, 6, or even 7 years. This is the dealership's golden goose. Gap insurance is what's known as a back-end product, and it's a massive profit center for them. They buy the policy from a third-party provider for a fraction of the cost, maybe $200 or $300, and then mark it up by 2, 3, or even 400%. That's pure profit for them. And because they've conveniently rolled it into your loan, you're not just paying that inflated price, you're paying interest on it for the entire term of your loan. That $1,000 gap policy could end up costing you $1,200 or $1,300 by the time your car is paid off. Now let's rewind. Imagine a different scenario. Before you even stepped foot in the dealership, you made a 5-minute phone call. You called the same company that provides your auto insurance, your Geico, your Progressive, your State Farm. You tell your agent, "Hey, I'm about to buy a new car and I'm financing it. I'd like to add gap insurance to my policy." Your agent will likely say, "Great idea. Let me add that for you." You'll hear a few clicks of a keyboard, and then they'll come back on the line. "Okay, you're all set. That'll be an extra $3 a month." You might ask them to repeat that. $3 a month? Yes, that's not a typo. The exact same protection is available directly from your insurance carrier for a tiny fraction of the cost. Let's do the math. $3 a month is $36 a year. Over a 5-year loan, that's a total of $180. Compare that to the $1,000 plus interest that the dealership was about to charge you. You've just saved yourself over $800 with a single phone call. In some cases, depending on your provider and your state, it might be as low as $20 a year. That's less than the cost of 2 lattes. So why is there such a massive difference? It's simple. The dealership is a middleman. They are reselling a financial product, and their entire business model is built on maximizing the profit from every single transaction, including the financing and the add-ons. They have commissions to pay, overhead to cover, and profit targets to hit. They are counting on you being fatigued from the car buying process and eager to get it over with. They use the convenience of rolling it into the loan as a major selling point, masking the true exorbitant cost. Your auto insurance company, on the other hand, is the direct source. There is no middleman. They are in the business of assessing risk and pricing it accordingly. For them, gap coverage is a simple, low-cost add-on to your existing policy. They already have you as a customer. They don't need to make a massive profit on this one specific product because they profit from your overall business with them. It's a volume game for them, not a high-margin sale. And here's another secret. You don't even have to get it from your primary insurance carrier. Many credit unions, if you get your auto loan through them, offer gap insurance at a very reasonable flat rate, often in the $200 to $300 range. This is still a fantastic deal compared to the dealership. There are also standalone companies that specialize in selling gap insurance directly to consumers online. A quick search can find you policies for a few $100s. The point is, you have options. The dealership's finance office is almost always the single most expensive place to buy this protection. The trap is that they make it seem like their offer is the only one, or that it's a special proprietary product only they can provide. They'll use phrases like "our dealership's protection plan" to make it sound unique. It's not. It's the same fundamental coverage. Think of it like buying a bottle of water. You can buy one at a fancy hotel for $8, or you can buy the same brand at a grocery store for $1. You're paying for the convenience and the captive environment. In the dealership, you are in their environment and they will charge you hotel prices. So the first and most important rule is this. Never, ever buy gap insurance from the car dealership's finance office without first checking the price from your own insurance carrier. The 5 minutes it takes to make that call or check online could literally save you close to $1,000. You can even do it on your smartphone while you're sitting in the dealership waiting for the finance manager. If they pressure you, just remember the numbers. Remember that they are trying to sell you an $8 bottle of water. But this brings us to an even more fundamental question. We've established that you can get gap insurance for cheap. But just because something is cheap, does that mean you automatically need it? Is it a smart purchase for everyone who finances a car? The answer is a definitive no. There are very specific situations where gap is a financial lifesaver, and other situations where buying it, even for $20 a year, is like literally throwing money away. It all comes down to the math of your specific deal. Your down payment, the length of your loan, and your car's depreciation rate. Getting this part wrong is just as costly as overpaying. So, how do you know which side of the line you fall on? How can you calculate with certainty whether you are a prime candidate for gap, or if you can confidently say no thanks and sleep soundly at night? That's exactly what we're breaking down next. To figure this out, you don't need a crystal ball or a degree in finance. You just need to understand one simple, powerful concept. I call it the equity equation, and it's the single most important calculation you can make when deciding on gap insurance. It's brutally simple. It's your car's current cash value, minus the amount you still owe on your loan. That's it. The result of that equation tells you everything. If the number is positive, you have equity. You're above water. If that number is negative, you have a gap. You're underwater. Your goal is to stay on the positive side. But modern car buying has created a series of traps that can plunge you deep into negative territory from the moment you get the keys. Let's look at the first and most common trap, the down payment. Or more specifically, the lack of one. Imagine a car buyer. Let's call her Sarah. Sarah has been saving, she's excited, and she's just found the perfect new crossover SUV. It's popular, it's reliable, it's $35,000. The dealership is running a promotion. $0 down. Sign and drive today. Sounds incredible. She can get her dream car right now without emptying her savings account. So she does it. She signs the paperwork, finances the full $35,000, plus let's say another $2,000 in taxes, title, and dealership fees. Her total loan amount is $37,000. She drives off the lot beaming, that new car smell filling the cabin. But something invisible and immediate has just happened. The second her tires hit the public road, that brand new car became a used car. It instantly depreciated. Industry experts say a new car can lose 10 to 20% of its value in the first year, with a huge chunk of that happening in the first minute. Let's be conservative and say her car's value dropped by just 10%. Her $35,000 car is now, 10 minutes later, only worth about $31,500 on the open market. Now let's run the equity equation. Car's value, $31,500. Loan balance, $37,000. The result? Negative $5,500. Sarah is $5,500 underwater before she's even made her first payment. If a truck runs a red light and totals her car on the way home, her insurance company will write a check for what the car was worth, $31,500. But her loan is $37,000. She will have to hand that entire check to the bank and then, out of her own pocket, write another check for $5,500 for a car that is now a twisted wreck in a junkyard. That is the gap. Now let's imagine another buyer, Tom. Tom is looking at the exact same $35,000 SUV, but he's a little more old school. He's been saving diligently and puts down 20%, which is $7,000. His loan is for the remaining $28,000, plus the same $2,000 in fees, for a total loan of $30,000. He drives off the lot. His car also instantly depreciates to $31,500. But let's run his equity equation. Car's value, $31,500. Loan balance, $30,000. The result? Positive $1,500. Tom is above water. If he gets in that same wreck on the way home, the insurance check for $31,500 would completely pay off his $30,000 loan, and he'd even get $1,500 back in his pocket. For Tom, gap insurance would be a complete waste of money. For Sarah, it would be a financial lifesaver. But it gets deeper because the down payment is only the beginning of the story. The next major factor is the length of your loan. Go back 20 or 30 years and a 4-year or 48-month car loan was standard. Today, 72 and even 84-month loans are becoming frighteningly common. Dealerships love to push these because it makes the monthly payment look seductively low. But these long-term loans are a depreciation death trap. Let's go back to Sarah, who put zero down. To get her payment down to a manageable number, she took an 84-month loan. That's 7 years. Here's the dirty secret of long-term loans. In the early years, your payments are almost all interest. You're barely paying down the principal, the actual amount you borrowed. So let's fast forward 1 year. Sarah has been a perfect customer, making her payment on time every single month. But because of how amortization works on a long loan, her $37,000 balance has only dropped to about $34,000. She's paid thousands, but only knocked $3,000 off the principal. Meanwhile, what has her car been doing? Depreciating. Like a rock. After 1 full year, that $35,000 SUV is probably worth around $28,000 if she's lucky. So let's run Sarah's equity equation again 1 year later. Car's value, $28,000. Loan balance, $34,000. Her gap has grown. She is now $6,000 underwater. She is in a worse financial position than the day she bought the car. She's running a race she can't win, where the value of her car is falling much, much faster than her loan balance. Now let's check on Tom. He took his $30,000 loan over a much shorter 48 months. His payments were higher, yes, but a much bigger chunk of each payment went straight to attacking the principal. After 1 year, his loan balance has dropped significantly, down to maybe $23,000. His car also depreciated to $28,000. Let's run his numbers. Car's value, $28,000. Loan balance, $23,000. He now has $5,000 of positive equity. His financial position has improved dramatically. He's building wealth in his asset, while Sarah is sinking deeper into debt. This is the brutal math of modern car loans. The longer the loan, the longer you stay underwater, and the wider the gap becomes. If you're financing for more than 60 months, you are almost certainly a prime candidate for gap insurance for at least the first few years of that loan. And that brings us to the third and perhaps most dangerous trap of all. It's a situation that millions of Americans find themselves in, and it's a guaranteed recipe for being severely underwater. This is the trap of rolling over negative equity. What does that mean? It means you're trading in a car that you still owe money on, and you owe more than the car is worth. Let's rewind Sarah's story. What if this wasn't her first car? What if she was trading in a 5-year-old sedan to get this new SUV? And let's say she still owed $10,000 on that sedan, but the dealership only offered her $7,000 for it on trade-in. That means she has $3,000 of negative equity. She's already $3,000 underwater on her old car. Most people in this situation can't just write a check for $3,000 to clear the old loan. So the dealership offers a slick, easy solution. No problem, the finance manager says with a smile. We'll just roll that $3,000 into your new loan. It sounds like they're making a problem disappear. What they're actually doing is burying a landmine in your new loan. So now, Sarah's new loan for the SUV isn't $37,000. It's $37,000, plus the $3,000 she still owed on her old car. Her new loan starts at a staggering $40,000. For a car that, remember, is only worth $35,000 on its best day. Let's run her equity equation on day one with this rolled over debt. The car drives off the lot and is instantly worth $31,500. Her loan is $40,000. The result? Negative $8,500. She is in a catastrophic financial position from the first second. She has a gap so wide it's a canyon. For this version of Sarah, gap insurance isn't just a good idea. It's an absolute, non-negotiable necessity. To drive without it would be one of the riskiest financial decisions she could possibly make. So these are the three giant red flags. A small down payment, anything less than 20%. A long loan term, anything over 60 months. And rolling over negative equity from a previous loan. If any one of these applies to you, you need to be paying very close attention. If two or all three apply to you, you are almost guaranteed to be significantly underwater on your loan for years. But this is all based on the financial structure of the deal. What about the car itself? Does the specific make and model you choose have a major impact? Does a fast appreciating luxury sedan put you at more risk than a pickup truck that holds its value like a champ? And what about the biggest exception to all these rules? Leasing? That's a whole different world where the dealer often includes gap automatically, but for a very good reason you need to understand. Let's dive headfirst into that world of leasing, because it turns the entire gap insurance conversation on its head. When you finance a car, you're on a path to ownership. When you lease a car, you are, for all intents and purposes, in a long-term rental agreement. You are paying to use the car for a set period, usually 2 or 3 years, and you're paying for the depreciation that occurs during that time. That's it. The bank or the manufacturer's finance arm owns the car from start to finish. You are just the temporary keeper. And this is precisely why gap insurance is almost always mandatory, and almost always baked right into your lease payment. The leasing company is not taking any chances. They have calculated, down to the penny, how much that car is going to be worth at the end of your term. That future value is called the residual value. Your entire lease payment is structured around the difference between the car's initial price, the capitalized cost, and that predicted residual value, plus interest, which they cleverly call a money factor. So, think about it from their perspective. They own a $50,000 asset. They've run the numbers and predicted that in 3 years, it will be worth $30,000. They've structured your payments to cover that $20,000 drop, plus their profit. But what happens if you drive that $50,000 car off the lot and total it 6 months later? The insurance company isn't going to look at the leasing contract. They're going to look at the market and say, okay, a 6-month-old version of this car is now worth $40,000. They write a check for $40,000, but the leasing company's books don't say $40,000. Their payoff amount is calculated based on their entire investment. It includes all your remaining payments and the car's residual value. That payoff could easily be $47,000. Who is on the hook for that $7,000 difference? You are. The leasing company will come after you for every single cent, because their contract says you are responsible for their asset. They are not going to eat a $7,000 loss because of an accident. This is the non-negotiable reality of leasing. The financial risk is enormous in the early stages, and it belongs entirely to the finance company that owns the car. So they eliminate that risk. They force you to have gap insurance. They don't present it as an option. They just build it into the deal. When the salesperson says, "Oh yeah, gap is included," what they often mean is, "We've rolled the cost of a gap policy into the capitalized cost of your vehicle, so you're not only paying for it, you're paying interest on it for the next 36 months. It's not a free perk. It's a mandatory and profitable part of the transaction for them. They are protecting their asset using your money. Now let's contrast this with that pickup truck we mentioned. Let's say you buy a new Toyota Tacoma. Historically, these trucks have freakishly low depreciation. You put $10,000 down on a $40,000 truck. You finance $30,000. In the first year, the truck might only lose $4,000 in value. So, 1 year in, you owe maybe $27,000 on a truck that's still worth $36,000. You have $9,000 of positive equity. The gap doesn't exist. In fact, you have the opposite of a gap. If that truck gets totaled, the insurance check for $36,000 will pay off your $27,000 loan. and leave you with $9,000 in cash to put towards a new vehicle. In this scenario, buying gap insurance would have been like setting fire to a few $100s. It would have done absolutely nothing. This is the fundamental difference. The Tacoma buyer made a large down payment on a slow depreciating asset that they are on a path to own. The person leasing a luxury German sedan made a small to zero down payment on a rapidly depreciating asset that they will never own. The risk profiles are polar opposites. Let's put some more concrete numbers on a lease to make this crystal clear. Imagine you're leasing a new $55,000 SUV. It's a 36-month lease with 12,000 miles per year. The dealer says the residual value after 3 years will be 60%, or $33,000. You pay $2,000 at signing, which covers your first month's payment and some fees. You drive away feeling great. 8 months later, a distracted driver runs a red light and T-bones your beautiful new SUV. It's declared a total loss. You're fine, thankfully, but the car is gone. Now the phone calls start. Your car insurance company's appraiser does their research. They look at auction prices, dealer listings, and market data for 8-month-old versions of your exact SUV with similar mileage. They determine the actual cash value is $45,000. This is the maximum they will pay, minus your deductible. Let's say you have a $500 deductible. So they cut a check for $44,500. You think, great, that should cover it. But then you call the leasing company to get the official payoff amount. And they give you a number that makes your stomach drop, $51,000. You're shocked. You ask, how is that possible? The car was only $55,000 to begin with, and I've been making payments for 8 months. But they have a formula, and it's not in your favor. The payoff amount includes the sum of all your remaining lease payments. It also includes the $33,000 residual value they were counting on getting back at the end. It's a complex calculation, but the bottom line is they need $51,000 to make themselves whole on their investment. The insurance company is paying $44,500. The leasing company wants $51,000. That leaves a gap of $6,500. Without gap insurance, the leasing company would send you a bill for a car that no longer exists. You would be legally obligated to pay that $6,500 out of your own pocket, or they would send you to collections and destroy your credit. But because gap was mandated and rolled into your lease, this is where it swoops in to be the hero. You file a gap claim. You provide the police report, the insurance settlement breakdown, and the lease payoff statement. The gap provider verifies everything and then cuts a check for $6,500 directly to the leasing company. The massive debt is wiped clean. You walk away with no car, but more importantly, no bill. You're free to start over. This is why leasing and gap insurance are inseparable. The structure of a lease creates a massive financial gap by design, and the leasing company legally requires you to be the one who insures it. They leave you no choice. So for anyone leasing, the question isn't, do I need gap? The answer is always yes. The real question you should be asking is, am I overpaying for the gap coverage the dealer is forcing on me? Because just like with a traditional loan, the dealership is not your only option. They love to present it as a simple one-stop solution. Just sign here, we'll roll it all into one convenient payment. It's convenient, all right? Convenient for them. They mark up the price of that gap policy significantly. The policy that might cost an insurance company $200 could be sold to you for $800 or even $1,000, and then they let you pay interest on that inflated price for 3 years. It's one of the most profitable products a dealership's finance office sells. So if the dealer is rolling it into your lease or your loan, is that ever the best deal? Or are you getting fleeced? Turns out there are 3 main places you can buy gap insurance, and the price difference between them can be staggering. We're talking hundreds, even over $1,000 for the exact same protection. And knowing the difference is the key to not getting ripped off. So let's break down that difference, starting with the most common, and by far the most expensive, place you'll be offered gap insurance: the car dealership. Picture this. You've spent hours, maybe even days, researching the perfect car. You've test-driven it. You've haggled on the price, fought for your trade-in value, and you've finally agreed on a number. You're exhausted, you're excited, and all you want are the keys. But you're not done. Now you have to go into the box. The finance and insurance office. The F&I office. This is the dealership's real profit center. It's a small, quiet room where a very friendly, very persuasive person is about to present you with a menu of options, like an expensive restaurant. Extended warranties, tire and wheel protection, paint sealant, and of course gap insurance. the F&I manager will pull out a slick brochure. They'll tell you the horror story we talked about earlier, about the car getting totaled and you being left with a $5,000 bill for a car you can't even drive anymore. And they're not wrong about the risk. The risk is real. But it's the solution they offer that's the problem. They'll say something like, look, we can add gap protection, and it'll only change your monthly payment by about $15. And you think, $15 a month to avoid a $5,000 disaster? Sign me up. Sounds like a no-brainer. But this is a masterclass in financial sleight of hand. What they're not highlighting is the total cost. That $15 a month isn't a subscription you can cancel. It's the result of adding a single lump sum charge to your total auto loan. And that charge from a dealership is almost always wildly inflated. We're talking $700, $900, I've even seen it as high as $1,500 for gap coverage. They buy it wholesale for a couple $100 and mark it up by $300, $400, or 500%. Let's do the math on a typical scenario. They offer you gap for a one-time cost of $800. They roll that $800 into your 72-month car loan. Now, you're not just paying back $800. You're paying interest on that $800 for the next 6 years. If your interest rate is, say, 7%, you'll end up paying over $1,000 for that protection. That's not $15 a month for a service. That's a $1,000 product they just sold you when you were tired and let your guard down. It's pure profit, padded directly into your loan. This is the convenience tax, and it is brutally high. Now for option number 2, which is a big step in the right direction. Buying gap from your auto lender. This means the bank, or even better, the credit union that is actually financing your car. This is a fantastic option for people who get pre-approved for their car loan before they ever set foot in the dealership, which, by the way, is something you should always do. When you're arranging your financing directly with your bank or credit union, you can ask them about gap insurance. They'll likely offer it too. But here's the key difference. Their motivation is different. A credit union, specifically, is a not-for-profit institution owned by its members. Their goal is to provide a service to you, not to maximize the profit from every single transaction like a dealership's F&I office. So what does this mean for the price? Instead of that $800 to $1,000 lump sum from the dealership, your credit union might offer the exact same level of protection for $300 or $400. It's often still a single lump sum payment that gets rolled into your loan, so you'll still pay some interest on it. But you are starting from a price that is less than half of what the dealer quoted. You've just saved yourself $500 or more with a single phone call, or by clicking a single box on your online loan application. There's no high-pressure sales pitch. There's no menu of other products you don't need. It's just a straightforward offer. They know that protecting their loan and protecting you, their member, is good business. So they offer it at a fair, reasonable price. Going through your lender is a solid, smart move that immediately puts hundreds of dollars back in your pocket compared to the dealership. But it's still not the cheapest way. It's not the pro move. The absolute best, rock bottom, most cost-effective way to buy gap insurance is the one most people have no idea even exists. It's not a lender, it's not a dealer. It's your own car insurance company. Think about it. Who are you already paying every single month to protect your car? Your auto insurer. Companies like Geico, Progressive, State Farm, Allstate. Nearly all of them offer gap insurance, but they don't call it a standalone product. They call it a rider or an endorsement on your existing auto policy. You are simply adding another layer of coverage to the comprehensive and collision insurance you already have. And this is where the numbers become almost laughably different. Remember the dealership's $800 lump sum, which became $1,000 with interest. Remember the credit union's much better $400 lump sum? Get ready for this. When you add gap coverage through your auto insurer, you're typically not paying a lump sum at all. You're paying a tiny amount extra on your regular insurance premium. How much extra? It varies, of course, but on average, you're looking at somewhere between $5 and $7 per month. Let's say it's $6 a month. That's $72 per year. Most people only need gap insurance for the first 2 or 3 years of their loan, until they're no longer upside down. So let's say you keep it for 2 years. Your total cost for full gap protection would be $144. $144. Let's put all three side by side. The dealership, over $1,000 with interest. The credit union, maybe $450 with interest. Your insurance company, $144. For the exact same thing. The same peace of mind. The same check that gets cut to pay off your loan if your car is totaled. It is, without a doubt, one of the biggest and easiest financial wins you can score during the car buying process. Now, there are a couple of important catches to this pro-level strategy. First, you usually have to add the gap rider when you first purchase the vehicle and add it to your policy. You can't call your insurance company 2 years into your loan and ask to add it. There's a very small window, so you have to be proactive. Second, it's tied to your comprehensive and collision coverage. If you drop those to save money on an older car, you'll lose your gap coverage too, but by that point you likely wouldn't need it anyway. The bottom line is this: the dealership relies on you being tired, uninformed, and focused on the monthly payment. They use the convenience of rolling it all into one big number to hide an outrageous markup. Your lender offers a fairer deal, cutting out the middleman. But your own insurance company, the people you already have a relationship with, offers the most transparent and radically cheaper option. Knowing this single piece of information doesn't just save you a few bucks. It saves you from a financial trap that millions of people fall into every single year. But what does that trap actually look like? How is it set, and how do you avoid stepping in it? To understand this, you need to picture the scene. You've spent hours, maybe even days, researching the perfect car. You've haggled on the price, you've taken the test drive, you've fallen in love with that new car smell. You've won. You've beaten the salesperson. You feel a sense of victory. Then they lead you to a tiny windowless office. This is the kingdom of the finance and insurance manager, or the F&I guy. This is where the real battle is fought, and most people don't even know they're on a battlefield. The F&I manager is usually the most charming person in the entire dealership. They're not the slick, high-pressure salesperson. They're your friend. They're here to help you with the boring paperwork, so you can get on the road. They'll congratulate you on your beautiful new car. They'll ask about your family. They build rapport. And then, as they're sliding a mountain of forms in front of you, asking you to sign here, initial there, they'll casually mention it. They'll say something like, "Okay, so your monthly payment is going to be $550. Now, for just another $15 a month, we're going to add on our comprehensive gap protection. This is something we really recommend for all our customers. You know how fast cars depreciate. If you drive this off the lot today and get into an accident tomorrow, your insurance might only give you $25,000 for it, but you'll still owe the bank $30,000. You'd be stuck paying $5,000 for a car you can't even drive anymore. Can you imagine? This protection wipes that debt clean. For the price of a few coffees a month, you get total peace of mind. It's a no-brainer. Let's just go ahead and add that in for you, shall we? Do you see what just happened? It was brilliant. First, they used fear, the terrifying and very real scenario of totaling your brand new car. Second, they minimized the cost by breaking it down to a tiny monthly figure. $15 a month. Who can't afford $15 a month? Sounds trivial. Third, they framed it as a foregone conclusion. Let's just go ahead and add that in. They assume the sale, making you feel awkward for questioning it. You're tired. You're excited. You just want your keys. So you say yes. Millions of people say yes. And the trap snaps shut. Here's what they didn't tell you. That $15 a month isn't the price. It's the result of the price being rolled into your loan. The actual price of that dealership gap policy was probably somewhere between $700 and $1,000. Let's be generous and say it's $700. They added that $700 to your total loan amount. So if you were borrowing $30,000 for the car, you're now borrowing $30,700. But it gets worse. You're paying interest on that $700. If your car loan is for 72 months, that's 6 years, at an interest rate of say 7%, you're not just paying $700 for that gap policy. You're paying the $700 plus the interest. Over the life of the loan, that $700 policy will actually cost you over $850. That $15 a month has cost you dearly. Now let's rewind. Remember your credit union? Or your auto insurer? You call them up and ask for a quote for gap insurance on the exact same car. They'll likely quote you a one-time flat fee. That fee is usually somewhere between $200 and $400. Let's take the average and say it's $300. It's a one-time payment. You don't pay a single cent of interest on it. So by making one phone call, you have saved yourself $550. $550. That's a car payment. That's a weekend trip. That's a significant amount of money they pulled out of your pocket simply because you were in their office at a moment of weakness. The dealership F&I office is designed to maximize profit on every single car sold. And these add-on products like gap insurance, extended warranties, and paint protection are their gold mines. The markup is astronomical. They are buying that gap policy from an underwriter for maybe $200 and selling it to you for $700, $800, $900, even $1,000. It is one of the single most profitable products they sell. They are counting on you being too exhausted and too eager to get your keys to question the math. They are counting on the psychology of the moment. Now, a common defense you'll hear from a finance manager if you do push back is that their policy is superior. They'll say, "Oh, that cheap insurance from your credit union? It's not the same. Ours is a premium product. It covers your deductible." This is a classic sales tactic. They create doubt about the competition. Let's break that down. First, many gap policies offered by credit unions and insurers also cover your deductible, often up to $1,000. You just have to read the fine print. Second, even if it doesn't, think about the math. Is it worth paying an extra $550 just to have your $1,000 deductible covered in the unlikely event of a total loss? Of course not. You're paying more than half the value of the potential benefit right up front. It makes zero financial sense. You're better off taking that $550 you saved, putting it in a high-yield savings account, and earmarking it as your deductible fund. The core function of every legitimate gap policy is identical: to pay the difference between your loan balance and the vehicle's actual cash value. The rest is just window dressing designed to justify a massively inflated price tag. They are selling you the same basic product in a fancier box for 3 times the price. But the trap has one more hidden layer, and this one is particularly nasty. Let's say you buy the dealership's expensive, rolled-in gap insurance. A year or two later, interest rates drop. You're a smart consumer, so you decide to refinance your car loan with a credit union to get a lower monthly payment. Here's the catch: in many cases, when you refinance and pay off that original loan, you automatically cancel the gap policy that was tied to it. It's gone. You've paid for years of coverage that you no longer have. Now you are legally entitled to a prorated refund for the unused portion of that policy. But do you think the dealership calls you up to remind you? Absolutely not. They are banking on you forgetting. The onus is on you to chase them down, fill out cancellation paperwork, and wait weeks, sometimes months, to get your money back. It's a bureaucratic nightmare by design. Many people never bother, or they don't even realize they're owed a refund. It's just more free money for the dealership. In contrast, when you buy gap from your own insurer, it's typically tied to your auto policy, not the loan. If you refinance, it doesn't matter. The coverage continues as long as you keep paying your insurance premium. If you buy it from a credit union as a flat fee, it's a standalone product. You still have to cancel it and reapply with the new lender. But the process is often far more transparent and customer-friendly, because their goal isn't to profit from the policy, but to provide a service to their members. So, the dealership trap isn't just about a higher price. It's a combination of paying more, paying interest on that higher price, and being locked into a system that makes it difficult to manage your own finances or get your money back. It preys on excitement, exhaustion, and a lack of information. Understanding this system, understanding the motivations in that little office, is your shield. It's how you walk into that room not as a target but as an informed consumer. You can smile, be polite, and when they make their flawless, friendly pitch for gap insurance, you can look them in the eye and say with absolute confidence, "No thank you. I've already arranged it through my own provider." The look on their face will be worth the price of admission. But this raises a critical question. If you say no at the dealership, what are the exact steps you need to take? When do you need to have it in place? Can you add it later? Or does it have to be done right away? Timing is everything, and getting it wrong can be just as risky as not having it at all. Let's break down the timeline, because this is where most people get tripped up and end up paying hundreds, sometimes thousands, more than they should. The single most critical moment in your gap insurance journey happens in a small, windowless office, usually after you've already been at the dealership for hours. You're tired, you're excited about your new car, and your defenses are down. This room is called the Finance and Insurance Office, or the F&I office. And this is where the magic and the wallet draining happens. You'll sit across from a friendly F&I manager who congratulates you on your new purchase. They'll have a stack of papers for you to sign, and they'll slide one across the desk that shows your monthly payment. And buried in that fine print, you'll often find a line item for gap protection or debt cancellation coverage, with a price tag that might be anywhere from $700 to $1,500. They present it as a standard, almost mandatory part of the deal. They'll say things like, "For just a few extra dollars a month, you can have total peace of mind." Here is the secret they don't want you to know. The gap insurance sold at a dealership is almost always the most expensive version you can buy. It is a massive profit center for them. They buy the policy from a third party for maybe $200 or $300 and mark it up by 300, 400, or even 500%. That friendly F&I manager is often a highly trained salesperson whose income depends on selling you these add-ons. But the biggest problem isn't just the inflated price. It's how you pay for it. When you buy Gap from the dealership, they almost always roll the cost directly into your auto loan. So that $900 Gap policy, you're not just paying $900. You're paying $900 plus interest over the entire life of your loan. If you have a 72-month loan at 7% interest, that $900 policy actually costs you over $1,100. You are literally paying interest on an insurance product. Think about that. Would you ever take out a loan to pay your regular Geico or Progressive bill? Of course not. Sounds absurd. Yet, millions of people do this every single year in the F&I office without even realizing it. So, how do you avoid this trap? You need to know your options before you ever set foot in that little room. There are 3 primary places to get gap insurance, and understanding the difference is the key to saving a fortune. First, you have the dealership. We've covered this. The pro? It's convenient. You can sign one paper and it's done. The con? It is, in almost every single case, the most expensive option by a massive margin, and you'll pay interest on it. Second, and this is the one you need to pay close attention to, is your own auto insurance company. Companies like Progressive, Allstate, Geico, USAA, most of the major carriers, offer gap insurance as an add-on or rider to your existing policy. And the cost is staggering in its difference. Instead of a $900 lump sum, you might pay an extra $3 to $5 a month. That's maybe $40 or $60 per year. Let me say that again. You can pay $900 plus interest at the dealership, or you can pay $40 for the entire year through your insurer. For the exact same type of protection, the pros here are obvious. It's incredibly cheap and it's easy to manage since it's part of a bill you already pay. The only potential con is that some smaller insurance companies might not offer it, or the coverage might be capped at, say, 125% of the vehicle's value, which is still more than enough for most situations. Your third option is to get it from the lender financing your car, if it's not the dealership's own financing arm. Think about a credit union or a major bank. They often offer gap insurance as well. It's typically a one-time flat fee, and it's usually much more competitive than the dealership's price. Think in the $300 to $500 range. This is a solid middle ground. Cheaper than the dealer, but probably more expensive than your own insurance company. Knowing this information transforms you from a target into a negotiator. So let's walk through the perfect strategy step by step. Step 1. This happens a week before you go car shopping. Call your current auto insurance agent. Tell them you're planning on buying a new car, and you want a quote for gap insurance. Get the exact dollar amount it will add to your premium per month or per year. Write it down. This number is now your secret weapon. Let's say they quote you $5 a month or $60 a year. Step 2, you go to the dealership. You find the car you love. You negotiate the price. You agree on a deal. Then they walk you to the F&I office. The moment of truth. The manager slides the paperwork over with that $900 gap policy already baked in. You look at it, smile politely and say, "I appreciate you adding that, but I won't be needing the dealership's gap protection. My own insurance company provides it for $60 a year. Unless you can match that price as a one-time fee, I'll just be adding it to my policy tomorrow." Watch what happens. The entire dynamic in the room will shift. You've just demonstrated that you're an informed consumer. You've taken away their leverage. 9 times out of 10 they can't and won't match that price. They'll try to sow doubt, saying their policy is better or more comprehensive, but it's rarely true. You calmly decline, they remove the charge, and you just saved yourself $1,000. But what about the timing? This is the other high-pressure tactic they use. They'll say, "You have to decide right now. If you drive off this lot without our protection, you're at risk." This is intentionally misleading. Most auto insurance companies give you a grace period, typically 30 days from the date of purchase, to add a new vehicle to your policy and elect coverages like collision, comprehensive, and yes, gap. So, the pressure to buy it in that room is completely artificial. Your action plan is simple. Say no in the F&I office. Drive your new car home. The very next day, call your insurance agent, tell them you bought the car, and have them add the gap coverage to your policy. It's that easy. You are covered, and you've done it for a fraction of the cost. Now, I know what some of you are thinking. This is great, but I already bought my car. I was in that little room and I fell for it. I have a $1,200 gap policy rolled into my loan right now. Am I just stuck? And the answer is a resounding no. This might be the most valuable piece of information in this entire video. If you purchase gap insurance from a dealership and it was rolled into your loan, in almost every state, you can cancel it at any time and receive a prorated refund. Let me repeat that. You can cancel it. Here's how it works. You don't call the dealership, because they have no incentive to help you. You need to look at your loan paperwork and find the contract for the gap policy itself. It will have the name of the actual insurance administrator and a phone number. You call that administrator directly and tell them you want to cancel your policy. They will send you a cancellation form. You fill it out, send it back, and they will process it. They will calculate the unused portion of your premium and send a refund check. Now, that refund check won't come to you. It will be sent directly to your auto lender, the bank that holds your loan, and it will be applied directly to your loan's principal balance. This lowers the amount you owe. So, if you cancel a $1,200 policy after 1 year of a 6-year loan, you could get a refund of nearly $1,000 applied to your loan. Then you simply call your own insurance company and add their $60 a year gap coverage. You've just clawed back a huge amount of money and replaced overpriced coverage with an affordable alternative. It's one of the single biggest financial wins you can get after the car buying process is over. The bottom line is this. The convenience of buying gap at the dealership is a mirage, designed to hide an outrageously inflated price tag. By making 1 or 2 phone calls before and after your purchase, you put the power and the money back where it belongs, in your pocket. But knowing where and when to buy it is only half the battle. The policy itself is a legal contract, filled with fine print, exclusions, and potential loopholes. What happens if your insurance company deducts for betterment or pre-existing damage? What if your loan includes negative equity from a previous trade-in? Does gap cover that too? The devil is truly in the details, and not all gap policies are created equal. In fact, some contain clauses that could leave you holding a bill for thousands, even if you thought you were fully protected. Let's start with that monster of a question, the negative equity from your last car. You traded in a vehicle you were upside down on, and the dealership, like a financial magician, made that debt disappear by rolling it into your new loan. Your new car loan isn't just for your new car. It's also paying off the ghost of your old car. So, if your new car gets totaled, does gap insurance pay off that entire inflated loan amount? For the vast majority of standard gap policies, the answer is a hard, resounding no. This is one of the most brutal and misunderstood realities of gap insurance. The policy is designed to cover the gap on the vehicle it's attached to, the one that's now a total loss. It is not designed to be a multi-car debt clearing tool. The insurance underwriter looks at the financing for this car, not the baggage you brought with it. So if you have a $35,000 loan, but $5,000 of that is negative equity from your previous trade-in, the gap provider will likely see their responsibility as starting from a $30,000 base, not $35,000. They will subtract that $5,000 of prior debt right off the top before they even begin their calculations. You thought you were covered for the full loan, but you're not. That $5,000 is still your problem. It doesn't just vanish. You will get a bill for it. But that's just the first crack in the armor. The list of what gap insurance typically doesn't cover is a minefield of financial surprises. Let's call it the exclusion list. And it's buried deep in the fine print of your contract. First up, and this one stings a lot of people, your primary insurance deductible. So many people believe that if they have a total loss, they won't have to pay a penny out of pocket. They think, my collision insurance covers most of it, and gap covers the rest, including my deductible. That is almost always false. Your gap insurance covers the difference between what your insurance company pays out and what you owe. But your insurance company's payout is calculated after they subtract your deductible. Let's run the numbers. You owe $25,000. Your car's actual cash value is $20,000. You have a $1,000 deductible. Your insurance company isn't going to send a check for $20,000. They're going to send a check for $19,000, the value minus your deductible. The gap isn't $5,000, it's now $6,000. But the gap policy is only designed to cover the gap between the loan and the car's value, not the payout. So they'll pay the $5,000. That last $1,000? That's your deductible. Still on you. You are almost always on the hook for your deductible, period. Next on the exclusion list: late fees, missed payment penalties, and other financing charges. If your loan balance is high because you've fallen behind on payments, Gap won't bail you out. They are insuring the principal balance of the loan for the vehicle, not the consequences of your payment history. They will get a detailed loan history from your lender, and if they see the balance has been inflated by hundreds or even thousands of dollars in late fees, they will subtract that amount from their payout. Now for the big one, the exclusion that can single-handedly create a new $5,000 gap you never saw coming. I'm talking about the extras you financed with the car. Things like extended warranties, service contracts, tire and wheel protection, paint protection, or even credit life insurance. When you buy a car, the finance manager often presents these as part of the total price, and they get rolled right into your loan. You might have bought a $30,000 car but ended up with a $36,000 loan because you added a premium warranty and a protection package. You'd assume the Gap insurance covers that $36,000 loan, right? Wrong. Many, if not most, Gap policies explicitly state that they do not cover the portion of the loan used to finance these non-vehicle products. They will ask for an itemized breakdown of your loan, and they will surgically remove the cost of that $4,000 extended warranty and that $2,000 tire package from the amount owed before they calculate your payout. Suddenly, the loan you thought was fully protected is $6,000 shorter in the eyes of the Gap provider. You get their check, pay off most of the loan, and then the bank comes calling for the remaining $6,000. Why? Because you still have to pay for a warranty and a protection plan for a car that no longer exists. It is a financially devastating scenario that happens every single day. If that's not enough, there's another trapdoor: the maximum payout limit. Some policies, especially cheaper ones, have a cap on how much they will pay. This is often expressed as a percentage of the vehicle's value. For example, the policy might state it will cover a loan balance up to 125%, or maybe 150%, of the car's MSRP or NADA value at the time of purchase. Let's see how this trap springs. You buy a hot new truck that's in high demand. The MSRP is $50,000, but with dealer markups you pay $55,000. You don't put any money down, and you roll in $3,000 in negative equity. Your total loan is $58,000. Your Gap policy has a cap of 125% of MSRP. Well, 125% of the $50,000 MSRP is $62,500. In this case, your $58,000 loan falls under that cap, so you think you're safe. But what if you bought a car that depreciates like a stone? Or you rolled in $10,000 of negative equity? Let's say your loan amount balloons to $68,000 on that $50,000 truck. Now your loan is well over the 125% cap. The Gap policy will only pay up to that $62,500 limit. Anything you owe above that is, once again, your problem. You could be left with a $5,500 bill simply because your loan-to-value ratio was too high for the specific policy you bought. Finally, there's the way the value itself is determined. Your primary insurer determines an actual cash value, or ACV. But some Gap providers reserve the right to use their own valuation, often citing a specific source like the NADA official used car guide. What happens if your insurer says your car was worth $20,000, but the Gap provider source says it was only worth $19,000? They will calculate the gap based on that lower number, leaving you to fight over or pay that extra $1,000 difference. All of these exclusions, negative equity, deductibles, late fees, financed add-ons, payout caps, and valuation disputes, are not rare. They are standard clauses in many of the policies sold across the country every day. The difference between a great Gap policy and a terrible one is how it handles these exact situations. A premium policy might cover your deductible, or it might have a much higher loan-to-value cap. But a cheap, basic policy will likely have every one of these exclusions, creating a false sense of security. You think you've bought a life jacket, but you've actually bought a sponge. It looks the part, but when you actually need it, it's just going to weigh you down. So the question becomes, how do you find the good policies and avoid the bad ones? Where you buy your Gap insurance from is just as important as the decision to buy it in the first place. Let's start with the place most people first hear about Gap insurance: the car dealership. Specifically, in that little office with the finance manager, after you've already spent hours negotiating the price of the car. You're tired, you're excited, you just want to get the keys and drive off. And that's exactly when they hit you with it. The number one advantage of buying Gap from the dealership is convenience. It's a one-stop shop. They present you with a form, you sign it, and the cost gets rolled right into your auto loan. Feels seamless. Feels easy. But that convenience comes at a staggering price. Dealerships are notorious for marking up the price of Gap insurance, sometimes by 300 to 400% or even more. Think of it like buying a bottle of water at the airport. You know it's just water, but you're a captive audience, so you pay $5 for something that costs a buck anywhere else. The dealership is the airport. They know you're in a rush to finalize the deal, and they're betting you haven't done your homework. A gap policy that might cost you $50 a year from your own insurance company could be sold to you at the dealership for a lump sum of $700, $800, even $1,000. But the sticker shock is only the first part of the problem. The real kicker is what happens next. Because they roll that inflated price into your car loan, you are now paying interest on your insurance. Let's run some simple math. Say the dealership sells you an $800 gap policy, and you roll it into a 72-month loan at a 7% interest rate. You're not just paying $800. Over the life of that loan, you'll pay over $180 in interest on the gap policy alone. So your $800 policy actually costs you nearly $1,000. You're financing an insurance product, and the only person winning that game is the lender and the dealership that gets a commission. On top of the inflated price and the interest charges, the policies themselves can be inferior. Dealership gap policies often come with a laundry list of fine print and exclusions. A common one is a benefit cap. The policy might state that it will only pay up to, say, 125% of the vehicle's actual cash value. If your loan balance is higher than that, which can happen with long-term loans and zero down payment deals, you're still on the hook for the difference. The very gap you thought you were covering still exists, just a little smaller. Some policies might also have clauses that void your coverage if you're even a day late on a car payment. It's a minefield, and you're navigating it at the most vulnerable point in the car buying process. So, if the dealership is often a bad deal, where should you look? Your first call should be to your own auto insurance provider, the company that already handles your liability, collision, and comprehensive coverage. This is, for most people, the single best place to get gap insurance. The advantages are overwhelming. First, the cost. Instead of a massive lump sum payment, your insurer will typically add it to your policy as a small recurring charge. We're talking about an extra $5 to $7 a month, or maybe $40 to $60 a year. Compare that to the nearly $1,000 true cost of the dealership policy we just discussed. Over the course of a 5-year loan, you'd pay maybe $300 total through your insurer versus $1,000 at the dealership. The savings are astronomical. Second, there's no interest. Because you're paying for it as part of your regular insurance premium, you're not financing it. There are no hidden costs. What you see is what you get. Third, it's simple. It's one less company to deal with. If your car is totaled, you're already working with your insurance company to handle the collision claim. Adding the gap claim to that process is incredibly streamlined. It's one phone call, one claims adjuster, one simple process. Now, it's not a perfect solution for everyone. There are a few potential downsides. Your insurance company will almost certainly require you to have both comprehensive and collision coverage on your policy to be eligible for gap. But frankly, if you have a loan on your car, your lender is going to require you to have those coverages anyway, so this is rarely a real obstacle. Also, not every single insurance carrier offers gap coverage, although most of the major ones do. The biggest potential drawback is that some insurer-based gap policies won't cover your collision deductible. So if the gap is $2,000 and your deductible is $500, they'll pay the $2,000, but you're still out that $500. In contrast, some of the more expensive dealership policies will cover your deductible. You have to weigh whether that potential benefit is worth the massive extra cost. What if your insurance company doesn't offer gap? Or what if you just want to shop around? This brings us to the third option: third-party standalone gap providers. These can include specialized insurance companies, banks, and especially credit unions. Credit unions, in particular, are often a fantastic source for gap insurance. Because they are member-owned and not-for-profit, they tend to offer financial products, including gap, at a much more reasonable price than a traditional dealership. Their pricing is often competitive with major insurers, offering that lump-sum convenience of the dealership, but without the predatory markup. If you go with a standalone company, you just have to do a little more due diligence. You need to make sure the company is financially sound and has a good reputation. Look up their AM Best rating, which is an indicator of financial stability. Read customer reviews about their claims process. The last thing you want is to buy a cheap policy from a company that disappears or fights you tooth and nail when you actually need them. So you have 3 main options: the dealership, your insurer, or a third party. To navigate this, you need a battle plan. You need a checklist of questions to ask any provider before you sign on the dotted line. Having these questions ready, written down on your phone or a piece of paper when you go into the dealership, is your ultimate defense. First, what is the total absolute cost of this policy? Is it a lump sum or a monthly premium? Second, if it's a lump sum that gets rolled into my loan, can you show me the amortization schedule? I want to see the exact dollar amount I'll be paying in interest on the policy itself. Make them show you the math. Third, what is the maximum payout limit? Is it capped at a certain percentage of the car's value, like 120% or 150%? Or does it promise to cover the entire gap, no matter how large? Fourth, and this is a big one, does the policy cover my auto insurance deductible? If so, is there a limit to how much of the deductible it will cover? Fifth, what are the exclusions? Ask them directly. Are there rules about vehicle modifications, commercial use, or what happens if a payment is late? Get a copy of the policy and read the fine print yourself. Sixth, is the policy cancelable and refundable? If I pay off my loan early or sell the car, can I get a prorated refund for the unused portion of the policy? This is crucial for lump sum policies. You don't want to pay for 60 months of coverage if you sell the car after 30. And finally, what is the exact process for filing a claim? Who is the contact person? What is the phone number? And what documents will I need? Asking these questions transforms you from a passive buyer into an informed consumer. It signals to the finance manager that you've done your research, and you won't be pushed into an overpriced, low-value product. Knowing these options is your armor. It protects you from the high-pressure environment of the finance office. But there's one more critical piece of the puzzle: knowing the exact moment you can and should get rid of your gap insurance. Because paying for it 1 month longer than you need to is just throwing money away. And we're going to break down that exact calculation next. So let's get right to it. The calculation is surprisingly simple, but it requires you to become a bit of a detective about your own finances. We're looking for what I call the freedom point. This is the exact moment your car is worth more than what you owe on it. The moment you have positive equity. Once you hit that point, gap insurance becomes a completely redundant, useless expense. You are literally paying for a service you can no longer use. Here is your 3-step plan to find your freedom point. Get ready to write this down or save this part of the video. Step 1. Find your loan payoff amount. This is not the same as the remaining balance you might see on your monthly statement. Your payoff amount includes the principal balance plus any interest that has accrued since your last payment. It's the single number you would need to write a check for to own your car outright today. The easiest way to get this number is to log into your auto lender's online portal. They almost always have a Request Payoff Quote button. Click it. It will generate a document that is good for about 10 to 15 days. If you can't find it online, you'll have to do it the old-fashioned way. Pick up the phone and call your lender. Ask them for the 10-day payoff quote. That's your first number. Let's say for our example, your payoff amount is $16,000. Step 2. This is the trickier part. You need to find the real, actual cash value or ACV of your vehicle. This is what an insurance company would actually cut you a check for if your car were totaled today. It is not what you think it's worth. It's not what you want it to be worth. It's what the market says it's worth. And here's a critical warning. Do not just look at the private party or retail value. Insurance companies pay out based on the car's wholesale or trade-in value because they're replacing the vehicle at its depreciated market rate cost. So where do you find this number? You need to consult the holy trinity of car valuation: Kelley Blue Book, Edmunds, and NADA Guides. Go to all 3 websites. Do not just use one. Enter your car's VIN, mileage, and be brutally, painfully honest about its condition. Is there a scratch on the bumper? A stain on the seat? A weird noise coming from the engine? Select the good, or even fair condition, not excellent. Nobody's car is in excellent condition unless it's been stored in a climate-controlled bubble. Look for the trade-in value or auction value. Once you have the trade-in value from all 3 sources, take the average. Let's say KBB says your car is worth $17,500, Edmunds says $16,800, and NADA says $17,200. Add them up and divide by 3. That gives you an average ACV of $17,167. That is your second number. Step 3. The moment of truth. You do the simple math. You take your car's actual cash value and subtract your loan payoff amount. Using our example, that's $17,167 minus $16,000. The result is a positive $1,167. Congratulations! You have officially reached the freedom point. You have positive equity. At this exact moment, if you were to total your car, the insurance company would give you a check for its value, $17,167. You would use that to pay off your $16,000 loan, and you would walk away with over $1,000 in your pocket. The gap no longer exists. Your gap insurance policy is now completely and utterly useless. It's time to cancel it. You should perform this checkup on your car loan every 6 months. Set a reminder on your phone. It takes 10 minutes and it can save you hundreds of dollars. The second that number turns positive, you make the call. So, how do you actually cancel it? This is the part that can feel intimidating, but it's your right as a consumer. The process depends on how you bought the policy. If you bought it directly from an insurance company like Progressive or Geico, it's easy. You just call them or go into your app and remove the coverage from your policy. Simple. But for most people, you bought it at the dealership rolled into your loan. This is where you need to be persistent. Your first step is to find your original gap insurance contract. Dig through that mountain of paperwork they gave you when you bought the car. On that contract, there will be instructions for cancellation and the name of the actual gap insurance administrator. It might be a third-party company you've never heard of. You have two main paths. You can call the finance manager at the dealership where you bought the car. Tell them, I have positive equity in my vehicle and I need to cancel my gap insurance policy. They are required by law to facilitate this. They will have you sign a cancellation form. Be prepared for them to be a little slow or unenthusiastic. They don't make money when you cancel. Stay on them. Follow up. Alternatively, and sometimes more effectively, you can call the gap provider listed on the contract directly. They will guide you through their specific cancellation process. Usually, it involves filling out a form, providing proof of your loan payoff amount, and an odometer disclosure statement. Now, here is the best part. The part that feels like finding free money. In most cases, you are entitled to a prorated refund. If you paid $2,000 for a 60-month policy and you cancel it after 30 months, you are owed a refund for the unused half of that policy, in this case $1,000. The refund will typically be sent directly to your auto lender to be applied to the principal of your loan, which is fantastic. It helps you pay off your car even faster. In some cases, if the policy wasn't financed, they might send the check directly to you. This is money you are legally owed. Do not let anyone tell you otherwise. The moment you cross into positive equity, every single dollar you continue to pay for gap is a donation to an insurance company. So let's bring this all home. We started this journey with the terrifying story of someone who lost everything because of a $10,000 gap. We learned that gap insurance is essentially negative equity insurance, a financial tool designed to protect you, the borrower, from a very specific and very modern problem created by long-term loans and rapid depreciation. We identified who the prime candidates are: the zero down payment buyers, the 72 or 84-month loan takers, the luxury car owners, and the high mileage drivers. We also made it clear that if you put down 20% or more, have a short loan, or buy a car that holds its value like a fortress, you can probably skip it entirely. We exposed the dealership dilemma, showing how buying it from the finance office can cost you double or triple what it costs from your own insurance carrier, and how rolling it into your loan means you're paying interest on insurance, a cardinal sin of personal finance. And finally, we gave you the exact actionable formula to know when to break free. The Freedom Point calculation, your car's value minus your loan payoff, is your key to unlocking hundreds, if not thousands, of dollars in savings over the life of your loan. Gap insurance is not a scam, but it is a temporary tool. Think of it like a life raft. When you're far from shore, upside down in your loan, it's an absolute necessity that can save you from financial drowning. But the goal is always to swim back to the safety of the shore, to the solid ground of positive equity. And once your feet touch that sand, the last thing you want to do is keep dragging that heavy life raft around with you. You drop it, you walk away, and you never look back. You are now more informed about gap insurance than 99% of the car buying public. You have the knowledge to protect yourself from a devastating financial loss, the wisdom to avoid overpaying for that protection, and the strategy to know the exact moment to shed that cost and put that money back where it belongs, in your pocket. You are in the driver's seat of your financial future.